prices and yields of coupon bonds. How would you determine the amount you would pay for a coupon bond? Recall the pattern of cash flows that this bond promises. A very naive approach would be to just add up each of the cash flows, the 19 payments of $10 each, and the final payment of the last $10 coupon plus the face value, for a total of $1,200. But of course, that would be wrong. Why would it be wrong? Well, first and foremost, it ignores the time value of money, the fact that a dollar received today is worth more than a dollar received tomorrow. Second, while we consider treasury bonds to be very safe, for any risky security, you would have to consider that a risky dollar is worth less than a safe dollar. In the case of a treasury bond, the willingness of investors to buy a fixed stream of payments will likely be lower if the perceived risk of inflation is higher. So inflation would be the main risk here. For a bond issued by a corporation or municipal government, investors may also need compensation for the risk that the issuer might default on the obligation and actually not make the promised coupon payments or repayment of principal. That is why we have to discount the payments and instead find the present value of the cash flows. Since the coupon rate on this bond was set at 1% every 6 months, it should not be surprising that if we discount the payments of the bond at a 1% semi-annual yield to maturity, or a 2% bond equivalent annual yield, then the price will be $1,000, presumably what the Treasury had in mind when they issued this bond. The yield to maturity is the interest rate that makes the present value of the bond's cash flows equal to its price. Let's see how this works. If we examine the coupon payments and compare the promised coupon payments to their discounted value, we can see that each payment in the future is discounted more and more, and then the final payment, which includes the last coupon and the principal repayment, is actually discounted the most. Why? Well, the 1% semi-annual rate is being applied over 20 periods. The sum of the present value of each payment is the price of the bond, $1,000, which of course is less than the sum of the undiscounted payments, $1,200. To be clear about the terminology, we call the 2% number the bond equivalent annual yield. Investing in a security that has a 6-month yield to maturity of 1% leads to more than a 2% return at the end of the year if you've reinvested the proceeds. You would in fact have a return of 1.01 times 1.01 minus 1 equals 2.01%, not 2%. So while traders, market participants, and the financial press quote bond yields using the convenient bond equivalent annual yield, which is just 2 times the semi-annual yield, these players would all understand that the true equivalent annual yield is a little more than 2% in this example, and you should understand that too. If you go back to the cash flows for this bond and use trial and error or a goal-seek function, you will find that the actual price at which the bond sold on the first day, $995.86, reflects a semi-annual yield of 1.023%. This is a bond equivalent annual yield of 2 times 1.023%, or 2.046%. The discounting reflects the fact that due to time and risk, the present value of these payments is lower than the contractually specified amounts. Remember that the investors in these newly issued bonds had ample other opportunities that day to invest in bonds, and it was those other bonds and other investment opportunities that ultimately led traders to pay $995.86, pricing it at a 2.046% annual yield to maturity. The law of one price tells us that the new securities should not trade at a premium or discount to other securities in the market with identical properties. The yield to maturity that priced this bond will be the yield to maturity on an alternative investment opportunity with equivalent risk. From this discussion, it should be clear that a higher discount rate, or yield, means a lower price. Price moves inversely with yield to maturity for bonds, since higher discount rates reduce the present value. This is one of the key principles of bond pricing. If you own a bond and the yield to maturity falls, that is good news if you are thinking about selling this bond because it means that the price of the bond has risen. The future cash flows are not being discounted as heavily by the market as they were previously. Now, suppose that an investor actually bought this bond at issue at the price of $995.86, which is equivalent to a yield to maturity of 2.046%. Does that mean that the investor will actually realize an annualized return of 2.046%? Well, the first point you have to keep in mind is that he gets 1.023% compounded every 6 months, which works out to something closer to 2.06% per year. But getting that is actually not a sure thing. Why? Two reasons. First, the investor has to hold the bond to maturity to realize the yield to maturity. I mentioned before that the price of this bond increased to $1,005.50 by March 6th from February 15th. So if you sold this bond right away when that happened, you would realize a profit. And if the price rose enough, you could realize much more of a profit than 2.06%, and that in just a very short amount of time. The bond price could also fall, and if you had to sell the bond, you would realize a loss. We call this risk interest rate risk because it reflects the possibility that the market might decide to discount the bond's cash flows at a different rate. If you hold it to maturity, though, interest rate risk is not a factor. You know exactly what you're going to get, assuming the bond does not default, which is our assumption about U.S. Treasuries. The second reason you don't get exactly the yield to maturity for sure is that the coupons must be able to be reinvested at the yield to maturity for the lifetime of the bond, not at whatever other rate might prevail at the time. And particularly for the payments that are closer to the maturity of the bond, such reinvestment prospects are not as favorable. For example, the last coupon coming off the bond can only be invested at the 1-year rate that prevails at the time, which in normal times is far less than the 10-year rate. What have we learned about pricing coupon bonds? The payments that you get from a standard default-free coupon bond are completely known ahead of time, but the amount that investors are willing to pay for that stream of payments is much less certain. Investors are asking themselves, how much do we have to be compensated for the time value of money, and also for the risks that we are taking? So what are these risks? Well, for issuers whose prospects are not totally certain, such as corporations and cities, yields are likely to be higher to reflect the fact that there is a possibility of actual default or non-payment of coupons and principal. Those yields are what you get if the bond matures without defaulting. They are not a sure thing. Now, in the case of U.S. government bonds, the risks involved with holding the bond to maturity are really limited to inflation risk, the possibility that your $1,000 at maturity will not even buy you a piece of chewing gum. But if you think you might want to sell the bond before it matures, even a treasury bond, then you're also subject to interest rate risk. Investors' demand for owning the bond could be up or could be down on the date that you want to sell it. We've also now covered some basics of bond math. When bond yields rise, their prices fall, and vice versa. This is because bond prices and bond yields are two sides of the same coin. The higher the yield, the more investors are discounting future payments. That means the less weight they are putting on payments out in the future. Investors prefer current payments to future payments because of the time value of money, and they're concerned about the risks of inflation, non-payment, or the ability to sell their bonds before maturity without realizing a loss.